I do like to start off every show with a summary of kind of what I saw happening in the market. So it's been a couple weeks. We didn't do a summary last week. I was out of town, but um, really, this market has had a phenomenal run since October of last year, in the face of all criticism, essentially, that has happened. With Wall Street has really, really gotten this wrong. The analysts have been wrong about company earnings on a really regular basis, but the vast majority of the articles and things that are out there were talking about how the market was going to go lower than we had back in October, and perhaps that's still possible. Correct? I mean, anything's possible. But we're really big believers that you've got to be very, very careful about what you read and what have you. Just watch the market. It's why we keep showing this chart. It's why it's on there. It's been on this since we started this show years ago. And the reason for watching the market is because the thought process is that it's in the price.
Yeah.
Right? That's the thing I always say to myself. Hey, everybody says the market's going to go down and the companies are going to make less money and what have you. And look, it's gone up, right? And look at what has happened. So it's a predictor of what's happening, right? There's a thing called the leading economic indicator, the LEI. It's a basket of 10 different indicators. The S&P 500 is one of those. It's a very well-respected overall basket of indicators, but the S&P is in there because it's a future predictor of what's going to happen. And so right now, the market's saying things are looking good. Yeah. Now, just in this last couple of weeks, we've had a little bit of a downturn happening here, and that actually caused a shift in our signals too. But if you recall, 2 weeks ago when we had the show, so I'm pulling up the same chart, we actually had a question that came up too, and that's why I use this chart, about a consolidation zone. Because I felt, if you look at that run that we've had straight up, that we were looking at a situation where we should see some softness in the market. We should see some up and down sideways motion. And it would be healthy, because if it just keeps going and going, like I say, it's kind of like stretching a rubber band. The farther it goes, the faster it goes, the tighter that rubber band gets, and to the point where it could snap, right? So what's happening now, and so I've kind of highlighted it here, is really, I think, the beginning of a consolidation zone that we're in now. And we can attach all kinds of things to it. They had a downgrade on the U.S. debt, right? And that brings the market down. And there's all these things. But when the market's in a go-go phase, it ignores an awful lot of bad news. When the market's in a down phase, it ignores an awful lot of good news. And in this particular case, when the market gets this stretched out, it's very likely that we're going to have a consolidation zone. Now, that could turn into a bigger downturn. We'll have to watch and see what happens. But if you look at our signals now, we are, yellow on our fast signal, and that just happened really today, right? And because of what's happened with this little bit of a downturn, but we're still green on the slower signal, and you can tell why. Market's still chugging along as far as that goes. We have a process, really the signals came from our internal process that we have, and I had a client once that asked me to kind of start broadcasting that, so we are. And essentially what it says is that, for our IRA assets and those things where we don't have to worry about taxable, transactions, we make adjustments based on these signals. We have a big basket, 175 ETFs that we're looking at on a constant basis, and they're all competing to get into the game, right? So oftentimes when you see these signals, when we do make changes, is because something that we have kind of fell out of that top group, and something else has moved back in. And so when the market really gets into struggle periods, you'll see defensive things start to move up to the top of this list. And we're actually not really seeing that right now. I mean, it's usually high dividend stocks, even the T-bill type ETFs, things that just don't fall much because the market's falling. We're not really seeing that. We're still seeing some strength coming out of the majority of our target investments have been into kind of the technology arena.
Big tech.
Yeah, and it's still working. Apple reported last night. I thought their earnings report was pretty good, but in this particular environment, anything at all will probably drop your stock a bit. The market's a little bit pessimistic.
Home run.
Yeah, which is what happened to Amazon.
Yeah.
So Amazon hits a home run. They're up tremendously. And so today's market, at least, at the beginning of the show, was basically flat, not much happening. But again, you go through these periods of time where, the market is kind of, let me go back to kind of our regular chart here, where the market is kind of, running, and it's funny to me how things get attached to the market. And so when things are falling, all of a sudden the negative news, there's still positive news happening that day.
Yeah.
It's kind of ignored, and they try to attach this negative thing to it. Because today, the jobs report comes out. Expectation was 200,000 new jobs. We had 187,000 new jobs, and this is for last month. This is a big report, very important report right now, because essentially what we want to see is some jobs created, but not too many jobs.
Yeah, not
right?
too hot,
And
Goldilocks.
not too low, right? And so I think 187 is really good. We were hitting 500, and that made the market really nervous, because essentially when you're creating tons of jobs, you can have a higher inflationary environment.
Yeah, and we didn't get to talk about this last week, but PCE came in on Friday,
Yep.
and that was also very good too.
All of the inflation indicators are good, right? I mean, they really have been. Some are better than others, and some things are coming down faster than others, those types of things. But the trend is definitely there. And it's why, the market doesn't expect another rate increase really this year. The September
I think
one,
it's 86% now. That's we hold.
Yeah, exactly. And so things are good. And look, the market has been predicting that for quite a while. And so, again, the philosophy that I think is important here to use is kind of a reactive philosophy and not a predictive one, right? I've talked about this all the time, but almost everything I read in the news is a prediction about what is going to happen. That's what sells. I don't have a problem with that, but it leads people to believe that they should be doing something based on those predictions. So, in other words, this year you would have been out of the market completely for the whole year if you were looking at all the predictions out there that said the market was going to fall apart, company earnings were going to be less than expected, we're going to have this big downturn, we're going to have these problems, right? And so if on the other hand, you do what we do and you kind of watch that price, and when it's coming down, all of a sudden all of these defensive things are coming up, and so you start to use those, and when it's coming up, all of these high growth things start to use those. I think, over the long term, it's the better way to get a return. Buy and hold works also. I really like the concept a lot. One of the issues that I have with pure buy and hold is that, you can't really, as a retiree, buy and hold through the next Great Depression, if we have one. So
Or the 08.
the last depression, the market was down 86% on the Dow, right? That's what was available then. And, it took forever, 15 years to come back. So if you're a 70-year-old retiree, for example, and you drop 87% on your stock market exposure and have to wait until you're 85 to get that back, and that's in the scenario where you're not withdrawing from that asset, right? Most of our clients are in that group, and so then you're really looking at a long time. So I do like, and I do advocate for some defensive posture when things start to get to a spot where you need to, and so that creates goods and bads. But we're gonna try not to ride through that next Great Depression, and you just never know what's going to happen out there. Even in 2008 downturn, that was down 54% from. That's a lot. It took 5 years to come back, which isn't terrible, but because those are the two factors that you always look at when you're talking about the stock market is, how much does it go down and how long does it come to get back, right?
Yep.
Those are the two issues. And so let's look at the signals for the bond market also, just real quickly here. So the bond market has been double red for a while. The slow signal has been red for quite some time. The fast signal's moved back and forth a little bit. But, and again, if you look at the bond market, it has been, at best going sideways this year.
Yep.
Yeah, looking at the price. We look at Vanguard Total Bond Market Index as kind of a proxy for the bond market. And yet we're having these red signals come out. And again, all of a sudden we end up with a downgrade on U.S. debt.
Yep.
Okay. Now, one of the things that's important to know is we were already downgraded once by one of the companies, S&P, right? And so in 2011, big debt ceiling argument, S&P downgraded our debt that we never got back up, which I find kind of incredible. And now Fitch, there's Fitch, Moody's, S&P are the three big companies, right? And so Fitch has now downgraded us to their second place from AAA to AA plus. And honestly, for me personally, I don't think it matters. I mean, it matters from the standpoint is they're making a message. I don't disagree with the message. Fiscally, there's probably better ways to run this country. But when we look at on a relative basis to the rest of the world, so there's only 7 or 8 countries in the world right now that have that top rating.
Yeah, across all three.
Yeah, and Germany and Singapore, for example, are 2. So when we look at, first of all, look at the common currency that runs the world. What is it?
It's the U.S. dollar.
It's the U.S. dollar. That's super important. Secondly, let's look at what happens in times of great stress. 2008, 2020, any of these big downturns that we've had economically, where does the money run to? Does it run to Germany? Probably some. Does it run to Switzerland? Probably some. Does it run to Singapore? Sure, some. But it really, really comes here.
Yeah.
And we can see it because we see massive gains coming into the price of treasuries. Some of that gain comes because they're lowering rates down to 0 often in those times, but it really runs, and you can see the flow. And we've been running these big deficits. How do you run those big deficits? You borrow money, and so we have no real problems borrowing money. And that, to me, that also means I think we should be the highest rated country in the world by far. I don't think there should be an argument about that. And unfortunately, these rating companies are the same companies that prior to 2008 were giving AAA ratings to these mortgage bonds, right? So they would get all these mortgages together, package them together, put them into a bond and sell them, and then take that money and go lend it to somebody else who didn't have any income. There was some crazy stuff going on at that time. They call them liar loans at one point in time. So, people ended up with, situations that they couldn't afford, but that's how they funded that. They kept selling those bonds. And of course, they're AAA rated. They're buying them all over the world.
Yeah, pensions had them.
Oh, yeah. Matter of fact, they up until the end, S&P was rating Lehman at a high enough rating to be in a pension, and Lehman went out of business and gone, right? So I don't know that I put a lot of emphasis on these ratings as far as I'm concerned. I really think that there's other ways of looking at it. The market will take care of itself. And I don't know that as many people put as much emphasis on the ratings anymore either.
Yeah, Warren Buffett, for example, Berkshire Hathaway has $100 billion in U.S. Treasury bills.
Yep.
And they said they're going to continue to keep rolling them over into the 3 months and 6 months as they normally do.
Yep.
And Berkshire Hathaway's been doing this forever. They have a kind of a barbell approach where they have their equities and then everything else is in cash, which they keep in T-bills.
Yep. Yeah. I mean, if it's good enough for Warren Buffett, it probably should be good enough for everybody else. He's essentially saying it's AAA rated, right, with his words. Now, there is one thing that's not being talked about as much that I do think has an important impact on the bond market, because really when you break things down, you got to focus on supply and demand, okay? So, for example, if we look at this stock chart here, in October, November, Bank of America does these big surveys of all of these big pension and mutual fund and hedge fund managers and such. And they had the lowest stock market exposure, okay, that they've had in the last 70 years at the bottom of the market there. Part of the reason the market comes up because all of those big money managers were done selling. And that means that there's less supply of coming on, new stocks coming on for sale. And so it doesn't take much for the market to start going the other way. Well, the same thing's true with the bond market. You got to focus somewhat on the supply. And so one of the problems that's happening right now for treasuries, and one of the reasons we're probably seeing red signals here that makes some sense, is the fact that during the debt ceiling debate, we reached our limit, 31 trillion, in February. And we went to what's called extraordinary measures, right? Remember that? And so we didn't get approval for new debt issuance to pay our bills until early June. And so in that time frame, they were not issuing new debt, right? Couldn't. It was against the, the debt ceiling agreement that had been in place from before. And so now we have this approval, and actually there's no dollar limit on it either. It is just a time. I think it's January of 2025 is when it'll happen again. And so And by the way, this whole debt ceiling thing is ridiculous. We're the only country in the world that has it. And if there is one good reason to downgrade our debt, that's probably it. I mean, nobody else does this. And
Yeah.
Australia was the last one. They were smart enough to, get rid of it in 96. And, we need to get rid of this darn thing. But nonetheless, because of that gap between February and early June, they're now having to issue more treasury.
Yep.
Right, to make up for it, because they were borrowing against pensions and there was all kinds of stuff going on, and that money all needs to be replaced. So we're kind of like double borrowing, and there's supposed to be roughly $1 trillion worth of treasuries issued.
And previously it was going to be 773 billion.
Yeah,
So it's like it's a pretty big jump.
Yeah, and so that will keep that going for a while, but that's temporary. Right, we're going to get through that. We're going to end up, but it is a supply. There's more supply of bonds coming on the market, and so the price of bonds probably comes down with higher supply, and that's kind of why we're seeing some red signals. Also,
you can see like the yield is slightly going up too with the supply, more supply coming online.
Yeah. Now I'm going to make a prediction here, just because I think it's kind of important to understand. I do think at some point in time here, once all this, so inflation's getting better, the Fed stops raising rates and starts being a little bit more accommodative in their talking, the new supply of treasuries gets done, so we're talking probably in the next 3 to 9 months, someplace in there. The bond market is going to be a pretty good purchase, right? Because the yield is pretty high. And I think we'll start to see some appreciation in price in the bond market to kind of catch up to some of the appreciation that we're seeing here in the stock market. So it could be a really good investment place. And I know it's been doing poorly, and I know people are frustrated with it, but I might be hanging in there on it now. I really think that there's some light that's coming, at the end of the tunnel, so to speak. It's not a train. So just keep that in mind. I think the bond market's going to be, and if you want to start accumulating bonds now, I don't see that as a problem either. Especially, if you're going to buy something that's going to mature, that doesn't matter as much. But if you're going to buy, an ETF or something that has bonds, that kind of continuously goes, you might make some money on price appreciation as well as that dividend yield. So anyway, that's kind of what we see happening. I think what's happening right now with the stock market is a good thing. We need to settle down. I think it continues for a while. Last year we hit the peak and that big run we had August 16th. So, August and September historically have been kind of softer months for the market anyway. That's good. Let's settle down. Let's just have some summertime and let's not worry too much about the market. It's still very healthy. Companies are still making money. Consumers are still spending. Amazon had great numbers that came out. I think there's some things that are really important to kind of understand here. This is okay, what's happening here. And even with the bond market, eventually all that new issuance of bonds gets put out there. And I think we're okay there also. And I really don't see anything on the horizon right now that's going to knock us down. And Fitch, who just did this rating downcrease, actually has, a recession scheduled for the fourth quarter of this year. I'd be surprised, but it's possible. I mean, the Fed Reserve has roughly 400 economists on staff. And during their meetings, they always put out staff recommendations. So the staff has been saying we were going to have a recession the first half of this year for most of last year.
Yep.
Didn't happen. So they moved that to second half of this year. Well, that doesn't look like it's going to happen either. So at the last meeting, just a couple of weeks ago, the staff said, well, we don't see a recession. So they went from, first half, second half to, well, we don't see one. And so Bank of America threw in the hat, they've been talking about recession. And just this week, they talked about not seeing one coming. So, again, be careful of what you read out there. Just look at what's happening with the markets. So bond market's not doing well. There's a reason, stock market's doing well. There's probably a reason. It probably continues, So anyway, that's what's happening this week. I really look forward to being able to kind of do another summary next week, and glad that you could join us for this one.